The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our time to talk taxes where we make you the smartest bears in the land. I'll tell you, when it comes to taxes, we sure want to keep you in the loop. And we're going to talk about all the tax law changes that are coming into effect. If you have any questions, you can give us a call, 803-0930, 803-0930, star 930 on a cell phone. Our text line is 716-803-0930. I'm joined in studio with Tiffany Fabian.
Hey there, Esther. Happy Saturday.
Happy Saturday to you.
Almost Christmas. Did you do all your shopping?
Well, mostly I just sit there with a pad of checks and a pen.
Yeah,
and then it fits all sizes.
This is
right?
true.
And everybody seems to be real happy with it.
Yeah, and this time of year, this
money.
time in the world, money is very important because there's a lot of people not
working.
working.
I did do some shopping for some people that I knew I absolutely couldn't mess up. But even when I thought I didn't mess up, people still sent back my gifts because I think your daughter, and Christopher Fabian, and your daughter too.
Hello, Esther.
Hello, Christopher.
I take no credit.
She said she wanted one of those really expensive Burberry bags. And so I went online to do my due diligence, and I got it $400 less than she that was expensive.
And she said you can never get a Burberry on sale.
Yeah, right. Everything is on sale if you look. Anyway, we're going to talk about all the tax law changes. You got 18 days for the end of this tax year, and I know we're going to be really happy that 2020 is coming to an end. I think we'll have things to really be thankful for January the 1st if this what is it called?
The
vaccination stuff works and everything. You got to give President Trump credit. He did it like a business. He made them go do it, and thank God that they did. Okay, so I wanted to let people know that we have an app, EG Tax app, and on our app
We've
this year,
had the app for a long time.
Yeah, but this is so cool. On our app, there's this section called Atom, right? ATOM, right? And in that portal, you can upload all. If we're doing your tax return, you can actually upload a copy of all of your information through our app, and it'll start a file for you so that it's completely touchless, so you don't have to even bring in your stuff. And I just thought it was so cool because, especially living with COVID, people are very concerned about all that kind of stuff. So it's really cool. So if you go to the EG Tax app at the EG Tax store and go to the Atom section, you can start your own.
It's not Atom. It's not Atom.
It doesn't. It does say Atom.
No, it doesn't. EG Tax is the app. Atom we use to.
It's our software.
I think.
Now Tim told me yesterday you go to Atom, but okay, I don't know. We'll look.
Atom is where we make our.
I know because that's where the portal is in Atom.
Maybe it is. Well, we'll get to the bottom of it.
We'll look. Anyway, that's cool. And then the other thing is, we've been listening to taxpayers saying we don't understand these letters that we're getting from the IRS. It makes no sense. What's going on? You want to address that, Tiff?
I called the IRS practitioner line a few weeks ago because I was helping a client, and one of the reps at the IRS said, we have trailers and trailers full of letters because during COVID they were furloughed, and so they're very, very, very behind. And so regrettably, they're trying to play catch up, and I think that maybe they're working with one arm tied behind their back.
And so what they do is they send out these notices, but they might have been mailed in additional information that would nullify the notice.
Right.
But when they haven't opened up the mail yet, so they don't know. And so if you're getting misleading or erroneous information, you can give us a call because we'll be very happy to work with you on your behalf to straighten it out. But don't be frustrated and don't pay it. That's
Right.
the most important
Above
thing, right?
all.
Don't pay it above all,
Yes,
right?
Yes. Yeah, I know. I've been doing some offers and compromises, and there's some people that have filed their tax returns late, like they did 5 years, about 9 months ago, but their offer is rejected because they didn't marry it up because they're so behind. And so what I've been doing is mailing the tax returns with the offer, so that way it's sort of foolproof.
So if you're getting weird stuff from the IRS, don't panic and don't pay it. Just give us a call. Chris, what you looking at?
I'm trying to figure out the app, but I was going to say, when I talked to them earlier this week, I said, "What's your ETA on doing catching up on the mail?" We don't have one. We have no idea when we're going to be all caught
and
up.
tax season really officially right now is supposed to open January the 15th. That's what they're saying. I mean, they may push back their opening, but we will have our offices opened up to help people, right? So why don't we go to the phones right away, and then we're going to talk about the tax law changes. We got our buddy from Georgia on the phone, Larry. Hey, Larry, how are you, sir?
Well, sweetheart, I'm doing great. Hey, Tiffany and Chris, how are you guys?
Hey, Larry, good. Merry Christmas. Happy holidays.
Happy Hanukkah, too, Larry. How are you?
Well, darling, listen, every day is a blessing.
It is.
I'm calling because I need your good advice.
Yeah.
I'm calling about the CARES Act. I get the fact that I can contribute $300 to charities and just put that on top of my deductions.
Right.
I get that. My question is, Esther, as I understand, because of the CARES Act, I can hypothetically contribute up to 100% of my AGI to charities.
60%.
Say it again.
60%. 60% of what you give to charity is going to be deductible this year. If you gave 100%, you're going to carry forward 40% to next year.
Well, okay, Esther, I may be wrong. That's why I called you. My understanding is that hypothetically one can contribute up to this year up to 100% of the AGI, and so if that's true, and it may not be, but if that's true, if I hypothetically contributed the equivalent of my tax liability for 2020, will I basically make it a wash?
Okay. You can only give 60% of your adjusted gross income and have it be deductible as an itemized deduction on the Schedule A. Now, the balance of that you might have given over the 60% carries forward to the next year. So I don't know who gave you that information, Larry, but it wouldn't be correct.
Okay, let me ask you this. If it carries over, right, will that 6% ratio still exist?
Yeah, it's next. Well, okay. So here's the thing. You're in Georgia, right? I mean, it's critical what happens at the upcoming election redo in the state of Georgia. If the Republicans are victorious and the Senate is still controlled by the Republicans, then I'm assuming that next year it'll still be the 60%, because it used to be 50%. Then they moved it to 60%, okay? And then your 40% would be carried forward to next year. If, however, the Democrats are successful and the Senate is not retained by the Republicans, then we're looking at a lot of potential tax law changes.
Okay. That's question two.
Told you. No, it's on the EG Tax app.
$100 is concerned. In fact, I've already done that, and I understand that I can just add that amount.
I mean, for sure, it's going to be carried forward, Larry. Even if they knock back the amount that you're going to be able to take next year to 50%, you're still going to be able to carry it forward. You carry it forward until it's always carried forward. So you don't have to worry about losing it. But no, you can't take 100%.
Esther, darling, this is why I call you, sweetie. Thank you so much.
All right. Thanks, Larry.
Bye-bye, dear.
Happy holidays. Bye-bye. All right. Well, we're going to take a short break. I'm Esther Gulius, the tax lady, 8030930, 8030930, star 930 on a cell phone, 716-8030930 is our text line. And we're going to take a short break. We'll be back with your calls and the tax law changes on the other side.
We are family. I got all my sisters
Hey, I'm Esther Gullius, the tax lady from EG Tax. And by the way, Larry, we double checked. There was under the
amendment.
CARES Act, they do let you take 100% this year. For most people, it's 60% going forward. That's what the law says. But this year, you can take 100%
And just in case you're
of
not
your
listening
charity.
right now, Larry, I will call you.
Right. Okay, let's go back to the phones. We're going to talk to Steve. Hi, Steve. How can we help you?
I don't know if this is within your purview or not, but with regards to Social Security, I just got a letter saying that I'm over the limit and they're raising the amount of money that I...
Your Medicare.
It's called IRMA.
Yep.
That's valid?
It can be. It depends. Now, was your income high because of a one-time event?
It might have been. Yeah, I think I took... yes.
Okay. So what I would suggest doing is calling us on Monday at the office, ask for myself, Chris, or Tim, and make an appointment. We'll sit down with you, and we'll help you fill out the protest form, and we'll see if we can get that reduced back to the 144.
Oh, okay.
Okay?
Have a good holiday season.
All right. Thanks, Steve.
Alrighty.
Thanks for calling. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. So Larry, if you're listening, it is 100% this year. So, but going forward, it's 60%. Okay. Some of the changes in the tax law, all of the tax brackets have increased so that there's more money in lower brackets. So that's one of the changes this year. It was increased for inflation. Kiddie tax is a big thing. I think a lot of parents are going to be shocked this year because a lot of their kids might have collected unemployment, and people don't realize that kids that you would claim as a dependent, if they have unearned income and unemployment is unearned income, the kids have to pay at the parents' rate. You want to talk about that, Chris?
Yes. So, I mean, there's a couple cans of worms that are going to open up with this. First of all, like you were saying, it's unearned income of over $1,100. So with the bonus in the unemployment, that was 2 weeks of the extra $600. So the automatic, boom, you get hit with the kiddie tax. The problem is going to be where these children were getting about $18,000 a year this year.
If they did the whole thing.
If they did the whole thing in unemployment, the 600s, the 300s, and then the 182 seemed to be the minimum they were giving out for unemployment. So that means like 18,000 plus their little bit of wages. So you're looking maybe about $20,000 that now the parents have to be able to prove support as well. So where the parents are, I get to claim my child, I get the education credit, they may not get the education credit.
Well, it may
this
be
year.
in the parents' best interest this
Right.
year, right?
Depending
to
on
not
the
claim
income.
the kid, and the kid then would have a lower, especially if they're in college, they would have a lower refundable credit for the AOTC, but at $20,000, can the parents really say that I gave $20,001 to the kid's support? So then you wouldn't have to worry about the kiddie tax because the kid would be claiming themselves. But it's something you have to walk through.
Right. Plus,
And-
what about, sorry, Tiff,
Oh, that's okay.
earned income credit?
Right.
There could be parents who are going to lose the earned income credit this
Because
year
their kids-
because
right.
their kids made too much on unemployment.
Right. So that's something you gotta
And
gotta
then
look at.
I think-
by the way, 1 second. Why don't you explain what kiddie tax is?
Kiddie tax, it started long time ago, almost like Star Wars. Galaxy far, far away.
Okay, all right.
It started because the government got smart. They realized parents were putting their own money in bank accounts in the kid's name.
That's when there used to be interest rates. Right.
And that was when the kids didn't have to pay tax.
Right.
So then the government changed it and said, well, kids have to pay tax.
At the parents'
At
rate.
the parents' rate. But it was only for kids under 5 years old. Then they changed it to kids under 12 years old.
And then?
And now it's children under 19 years old or or under age 24 if they're a full-time student.
And claimed as a dependent
and claimed
on their...
as a dependent.
Right.
So, and good thing, there is a good thing of this. 2 years ago, the kiddie tax was based on the estate tax rate.
Which was
Well,
a much
that's what
higher
I
rate.
was about to say.
Okay, I'm sorry,
Yeah,
Tim.
they stole my thunder.
Yeah, so that was 37%.
And then they changed the law
and
to
they changed
make
it back
more
to the
equitable.
parents.
Parents.
Right.
So it's a
So
little bit better of a
anyway, these
situation.
kids then that have unearned income, which they don't care where the unearned income comes from, have to pay at the parents' rate. So some of you parents may not want to claim the kid because they might have to have kitty tax this year because of unemployment. By the way, getting back to the app, Tiff looked that up, and if you go to the EG Tax app, you do go to the Atom section on the
misunderstood you.
EG Tax app to upload your information so that it's touchless and you can start your portfolio online.
Yep.
Right?
Correct.
Okay. Okay, so getting back, and again, 8030930, 8030930, star 930 on your cell phone. All right, so medical expenses are deductible at 7.5% of your adjusted gross income.
Yep, same
right?
as last year.
But on the state, it's 10%.
Right, and this is right now, this is the last year for that.
Right. State and local income taxes are limited at $10,000, $5,000 married separate.
Correct.
Right?
Right. That's the SALT
charitable
that started
deductions
in 2018.
Under the changes in the tax law is limited to 60%. However, and if you don't itemize, it's $300 that you can take as an adjustment. But
And-
under the CARES Act, you can give up to 100%
And,
of your
and a
adjusted
really
gross income.
sad thing is, of course, if you're a married couple, that $300 charity donation is just $300. Whereas if you're
Two people living together,
living
it'd be
together, you get
$600.
$600. So sad, but there's somebody called the caller yesterday about that, and it's almost another penalty. It isn't.
It is
almost.
another penalty.
It is another
It
penalty
is another
for being
penalty.
married.
All right, then the earned income credit, which is really, really important. Those people that have income like under $50,000 with children living in their home, the earned income credit this year goes up to $6,660. If you don't have kids in your home, it's up to $538. But many people that got the earned income credit in the past may lose it because of the unemployment of their kids, right?
Yep.
Right.
Or because they just got unemployment and didn't work. So
Because it's
wages
an
are what you
earned
need to get the
income
earned
credit.
income credit.
Yep.
Right.
Right?
Correct.
Okay, and then let me see what else we got here. Adoption credit. If you adopted children, the credit for adopting a child is $14,300, even if you didn't pay for it, if you had a special needs child.
That's right.
Correct.
So you would cut your tax liability by $14,300 by adopting a child. The maximum income that you can do to get this is $254,520. Lifetime learning credit. It was supposed to phase out, but it's still in through 2020. So if you don't qualify for AOTC, you move to lifetime learning, and that's 20% of the first $10,000 in higher education,
And
right?
and they
Forever.
increased the income limit to
Per-
that to 118.
Yep, and that's for the entire tax return, whereas AOTC is per student for the limit.
And then we got, foreign income exclusion. So if you're living outside of the United States and you have foreign earned income, that exclusion moved to $107,600.
Right. And that includes Canada.
Right, because we don't think of Canada as a foreign country, but because we're so closely related. Of course, I do feel like it now because they can't come up to see us, and we can't come to see them.
I heard they're taking helicopters to come over here.
But when we were driving here for the studio, the signs over the 290, Easy Pass now, Easy Tolls now on the Peace Bridge. I'm going, that's great, but we can't use the Peace Bridge, so why have that up there?
Well, hopefully with this COVID thing under control. All right, and then the pension and IRA contribution limits, this is all going to be on our website, right, Chris?
Yes.
So you can look specifically, but I will tell you, if you haven't made your 401k contribution or your 403b contribution, you got 18 days.
That's right.
Right? You want to make sure you do that and use your cafeteria plans.
Yes.
Right?
Yep.
RMDs, there was no required minimum distribution this year, regardless of your age.
Yep.
Right.
That's right.
So if you did it, you had, I think, till August the 15th to put the money back. If you didn't, you're stuck with it on your return. But starting next year, if you're age 72 or older, you have to do a required minimum distribution on 21 income on your 21 pension,
which of course is higher than it was the year prior. So it moved up to 72 instead of 70 and a half.
Right. Also, if you're, and this is really important, if you have IRAs and pension plans, you want to make sure you designated a beneficiary. Why is that important?
Oh my God! Otherwise it goes to probate, and then it just holds up your money and holds up your money. And when it goes to probate, it's state tax you have to pay, and so please avoid that at all costs.
But also, there's the way you have to take it out.
Right. But if it goes to the estate, it's 37%.
Right.
As of right now, it could go up to 39%.
But if you don't have a beneficiary, because of the estate tax. But secondly, with the beneficiary, it lets you have the opportunity to have the beneficiary take it out instead of one lump sum over a period of time.
Right, depending on the age difference between the person that deceased
but
and
it still is either 10 years or
it can be 10 years or over their whole life.
Right.
So.
All right, I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. We'll make sure that we are going to give you more information on the other side of the news with all the tax breaks and all the tax changes, and we'll see you in a minute. Hi, I'm Esther Gulius, the tax lady from EG Tax, and we want you to think of us as family. I will tell you, there's so many changes that have come down the pike between the changes that they passed and then all of the emergency changes in the CARE Act. There's a lot of things that you need to be aware of, and we're talking about them. But in the meantime, if you want to give us a call, 8030930, 8030930, star 930 on a cell phone. Okay. Then let's see what else we got. We got retirement plan distributions. You can take, because now this is because of the CARES Act. You can take up to $100,000 out of your IRA if you're under or your pension plan under the age of 59 and a half without a penalty, and you can elect to pay it back within 3 years. As
long as
if you replace it.
As long as you were impacted by COVID.
And nobody's really said what that means.
Definition.
Well, they say you had
Taking
it,
care
a
of
family member had it, you lost your job.
Or your kids were not being able to be gone to daycare because somebody had it. But, you just wonder how if somebody really challenged that and said, lost my job. Right. Mm-hmm. That would be another thing. But you have to be impacted by COVID.
I could see a salesperson who usually makes $150,000 who's only making $75,000 because he's not getting his bonuses.
Right.
Yep.
Or her bonuses.
Yep.
Right. The other thing is starting 2020, and this is really important for people that are over the age of 70 and a half, what can they start contributing to?
They can put money into an IRA.
If you have wages, right?
Right.
Or you're supposed to have
Or if
wages.
you're spousal
So you're no
IRA.
longer limited by your age.
That's right.
So that's a cool thing. That's a great tax planning tool.
Yep.
All right. Retirement distributions for births and adoptions. You can now take up to $5,000 out of your IRA or your pension plan, penalty free if you had a birth or an adoption.
That's so
Right?
nice. Yep. All those unexpected expenses.
Right. Okay. And we got some text.
There's a text that says, any news on another stimulus package?
Well, I think they're trying.
Yep.
And I will tell you everything I've read. It's going to be $1,200 per person, including children.
That's great.
Now, here's another really important thing. On this year's return, on the 2020 return, there's a reconciliation section that reconciles what you should have gotten with what you did get. And if you didn't get it, they'll give it to you. Or if you didn't get it because your income was too high, it's going to let you reconcile it because your income was lower, and you will get it again. So that's really, really important coming up on this year's return.
Right.
Okay?
Right.
All right,
there's
let's go to the
another
phones. We're going to
text.
talk
There's
to
another
Scott.
text,
Hi,
too.
Scott. How can we help you?
Hey, thanks for taking my call. It's
Yeah.
a question regarding my 401k and my Roth IRA. Is there any way that I can commingle those funds?
Well, I wouldn't. I mean, you should. There are some non-deductible contributions that people have made in their traditional IRA, and so you have to keep track of that. But you cannot commingle your traditional and your Roth IRAs because the Roth is tax-free, and so there's no way for you to reconcile that. So your Roth is one, your traditional is another.
Yeah, it's like apples and oranges.
Right.
Okay, my second question is this. Considering that Biden's going to, be our next president, do you foresee my 401k taking a big hit?
If I had a crystal ball, Scott, I can only tell you we're going to give you all of the projected things that they're proposing, and so they're proposing tax increases. How that'll all play out,
on the Senate
who
race
knows?
Too.
Well,
I think it depends on the
and
Georgia
it does,
runoff.
and it depends on the Georgia race.
Yeah, for 2 months you can turn it into safe mode instead of going moderate or high risk, and then if you see the market staying constant, go back into it.
Yeah, I don't know what I'm just asking, obviously, your advice, being the financial experts. But
well, I will tell you, we're tax experts. We're not investment specialists. But but what we try to do is we try to give everybody the straight scoop here. And a lot of the changes that they're proposing out of the Biden administration are for substantial tax increases, and who knows how that'll affect the economy. I'm flabbergasted that the stock market is over 30,000.
Right.
I'm flabbergasted right now. So who knows? I would suggest you call your financial person and see what they say. But I think what Chris says is to do a steady course and watch and wait.
Thanks for your.
All right, thanks, Scott.
And again, we're not financial people, but he brings up Biden, but it can also be, is the virus working? Or is the vaccination working? Because if the vaccination works and people are going back to work, then
that would be a wonderful
the market
thing.
Would stay good. But if
that would be a
vaccine
thing.
Doesn't work, I can see the market going.
Well, and then it could be a combination of high taxes and you just don't know.
Yep.
You don't know, and it depends if the executive branch, the legislative branch, and the judicial branch all goes to one party, then the checks and balances aren't there. So you gotta,
as Schumer says, then we take America. That's what Schumer says.
Okay.
There's a text that says, for 2020, I purchased my health insurance through New York State of Health. I did receive a subsidy. However, the funds I received from my lawsuit for lost wages has brought me over the income I used to qualify for the subsidy. Will I have to pay the subsidy back? And so can I avoid doing that by contributing to a traditional IRA to bring my income back down to the normal $38,000 where I qualify for the subsidy?
All right. So because it is wages that you got paid, that's going to be taxable. And so, yes, you can contribute to an IRA, and that will help because there is a reconciliation that you have to do between the subsidy you received based upon what you had told them originally when you were looking for the subsidy and what actually happened. So that putting money into your traditional IRA will help.
Yes, that's a very smart thing to do because then you're paying yourself and not paying the government.
Right, but here's the thing. You have till April the 15th of 2021 to make that contribution. So when you're preparing your return, you can see how much that subsidy you're going to have to pay back of that subsidy. Let's say that you only have to pay back $400 of the subsidy. You might say, I don't think I want to put that much in my IRA.
Right.
But putting money away in your IRA is a great thing anyway. Yeah. And what this person might end up doing, especially if there's children involved, they might be getting an earned income credit, right?
That's right.
And that would help to increase their earned income credit.
Yep.
So,
and what they should have done is they should have gone under the New York State Health and rectified and made changes to the fact that they got that back.
Oh, if
pay.
we lived in a perfect world.
Right.
People don't like to do that.
Right. Nobody does.
I'm Esther Gullius, the tax lady from EG Tax. We're trying to get you up to speed here on the 2020 tax return. We got more of the changes coming up. 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. Okay, so other things. The extenders, that they remember the extenders that they said that they weren't going to extend, but they keep extending the extenders. So they did extend them through 2020. And so first thing is the exclusion from gross income for discharge of debt income from qualified principal residence debt. In other words, if they forgave a mortgage that you had on your personal residence, it was going to be potentially taxable. But under the extenders, they said that if it was a debt forgiveness due to your personal residence, it is not taxable.
And, I got to tell you, in the world of COVID, thank God that they did it, because people are really suffering. People are losing their houses. They're losing their cars.
What kills me is when I drive around and I see going out of business.
Yep.
Lord and Taylor. We
Pier
drove
1,
by Lord and Taylor today.
Steinmart.
It's so sad.
Steinmart.
Okay, the other thing the extenders extended was the MIP deduction, mortgage insurance premium deduction.
Yep.
Right?
And that's still there.
That's still there.
now.
Tuition and fees deduction for higher education.
Adjustment
So
in
if you don't have an American Opportunity Tax Credit, don't qualify, or you've used up
too
all
high.
of your lifetime learning, you can also, if your income's in the right place, can use the tuition and fees deduction for higher education. That's still in there. Non-business energy property credit, still maximum $500 lifetime, still in there for the extenders.
Right. So windows, doors, if you get the
If you
super
haven't
high
used it.
efficiency
Right.
furnace.
But I got to tell you, most people have used that unless they're brand new homeowners.
But it's $500 lifetime.
Yep.
Medical expense deduction, subject to 7.5% adjusted gross income. On the state, it's 10%. So that was the change in the tax law. We talked about the economic stimulus reconciliation. You guys want to talk about that anymore?
Well, again, that's if you got $900 instead of $1,200 because of your income. If your income came down, you may be entitled to the other $300. If you had a baby this year, you may get an extra $500. These are all things we're trying to see.
And who
or
knows,
if
if they
you-
really do come up with this extra $1,200, they might say that's what's going to be in the tax law. I mean, we don't know. They still have 18 days to mess
Hammer
up
it
the
out.
tax code, right?
Right. And then if you regrettably had a spouse who passed away and you got too much for the deceased spouse, you might have to pay it back, or if you've already mailed it back. Yep.
Right.
Yep.
Because, everybody has to reconcile using this reconciliation for portion of the tax return with what you got in stimulus, because you may get more money back. Right?
Right.
All right, let's go back to the phones. We're going to talk to Jim. Hi, Jim. How are you, sir?
Good, thank you. Good question. I'm 75. My wife is 64. We're both working. The minimum, or the amount you have to take out of your IRA once you.
You don't have to do it this year.
72.
This year, in 2020, you did not have to do a required minimum distribution because of COVID.
Okay, so I don't have to pull anything.
You don't have to do
But
it.
you
But
might
starting
want to.
2021, you do. But you and your wife are both working, and regardless of your age, Jim, you can make a contribution to an IRA.
Yeah, I realize that. Yeah.
So that's cool.
Yeah. Okay, that.
All right.
I think that's my only question.
All right. Thanks, Jim.
Merry Christmas.
Merry Christmas. Bye-bye. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. We're going to take a short break, and on the other side, we're going to talk about last-minute moves. You got 18 days to pull a rabbit out of a hat, so to speak, especially if you're in an industry that's done especially well despite COVID. I'll talk to you on the other side. Hey, I'm Esther Golias, the tax lady. Your family to us, I will tell you, if we don't know, we're going to look it up. We certainly, with taxes the way it is, you got to really keep running to stay up with all the tax law changes. And we do have 18 days before the end of the year, and it is absolutely possible for them to pull something that we haven't told you about. But if they do, we will let you know. Some last-minute tax moves that you should do is, we mentioned it before, if you have children in your home, or if you're under the age of 65 and you want to get the earned income credit, you need wages.
That's right.
So I know in 18 days it's tough to do some
I was
wages.
talking to
but
somebody who called the office 2 days ago, and he said he has been on workman's comp and unemployment for
doesn't
the
count.
whole year, and
Yep.
his wife is disabled, and she just gets Social Security. They have young kids at home. I'm like, oh my God, you didn't work a little bit?
Yeah.
No, he goes. So
they'll lose. They won't get the
didn't
money,
even have
and
to
that's
file.
like $8,000
Yeah,
that potentially
yeah.
between the state of New York.
I said he would get a little bit from
now,
New York for the
now,
Empire credit.
because of the kids.
Right.
Sell losing stocks to offset gains. If you have something in your portfolio that's losers and you take a look and you've gotten all kinds of capital gains this year, sell your losers. You can buy them back in 31 days, right?
That's right.
Because if you buy it back within 30 days, then it's a wash sale. It's not deductible. So that's something you should take a look at this year. Buy business assets. If you're a business that's made money and you are trying to reduce your net profit, you have 18 days to buy some business assets.
I got to tell you, we went to buy. I mean, there are certain businesses that are doing really good, cleaning businesses,
Right.
anything to fix
Toilet
your home.
paper businesses.
We went to buy a Christmas tree yesterday, and there were like no Christmas trees because they said people are just going out and getting the trees right away because there's nothing to do.
Oh, I see.
Yeah.
Well, I know a lot of, like, our sign on the boulevard blew down, and the sign guy came out. He put up a temporary. He goes, we're having a hard time getting supplies to make signs because of COVID, because people aren't working and it's taking longer. Building materials are rare, are scarce right now. It's tough.
Yeah.
Yep. What was I trying to buy? And they said,
treadmill.
furniture.
yeah.
You can't get any furniture either.
Treadmill.
Couches. I think that your daughter was looking for a couch,
Right.
right? There's no couches. Apply for PPP forgiveness if you're a business that received the payroll protection provision. You want to make sure you get that in because if you did get that money, you can have it forgiven. You have to put it. You have to make that application and get it forgiven. Put money into your pension plans if you still have 18 days to do that. Use your cafeteria money. We talked about that. Charitable. Make sure you give you make your checks to charity if you want a deductible. Make them deductible this year.
Right.
And let's go to the phones. We're going to talk to Russ. Hi, Russ. How can we help you?
Yeah, hi. I was wondering, we bought a house, and I was thinking about selling some stock to pay it off. Now, I'm wondering what's going to happen with capital gains. Is it going to go up?
Well, supposedly, that's another thing that's in the Biden plan. Capital gains, if they pass it, is going to be taxed as ordinary income. Right now, you get a great benefit. The maximum you would pay is 20%. If you're in the 15% bracket or lower, it's 0% on the federal. So if they should be able to secure the House and the Senate, then you're probably looking at increases in capital gains rates. So something you might want to take a look at.
Increases to
Your ordinary income. So it all depends on what your income is. What is your income right now, Russ?
Well, I'm only working part-time now, but do they count your Social Security as income?
Well, it all depends. So
Yeah.
give me an idea what your wages are.
Well, I make about $30 an hour.
Okay, so are you making like $40,000-$50,000 a year?
For my wages from where I work, you're saying?
Yeah.
No.
Well, anyway, so let's say that you're in the 10% tax bracket. Then if you have capital gains, then you would pay at whatever tax rate you're at. So if you sold stock and you had a $100,000 gain, that might move you to the 20% bracket, so you'd pay an extra 10%. So you want to keep your ears to the ground, because once they change the law, hopefully as they're debating this, we'll keep you posted and you can make those moves. But I would not go ahead. I mean, when you take a look at what you're paying on your mortgage, 2 or 3%?
No, it's more like 4, I think.
Have you thought of refinancing?
Yeah, oh, yeah, I'm thinking about that too. But
all right, but I mean, if you can get a 2% loan, that's a whole bunch better than paying 20% in taxes, or 30 with the state.
definitely, yeah.
Okay, because think about how many years. It'd be 15 years at 30% before you'd equal what you would pay in taxes. So you got to put a pencil to it.
And I would
Okay,
talk
Russ?
to your stockbroker too. There's a text. It says, "Hi, if I put my children on my deed, do I have to pay a gift tax for that year? House is over 100,000, and that's the question."
Okay, so if you put your children on the deed, that means that you're gifting them the house, and you have to do a gift tax return. So you wouldn't pay a gift tax because you'd have to do a gift tax return, but you'd be able to exclude that $100,000 against your unified exclusion. So.
So it wouldn't cost
and the
you
other
anything.
thing is, once you put the kids on the deed, then the stepped-up basis goes away. But I will tell you, under Biden's plan,
There's
he
not
wants to
gonna-
get rid of the stepped-up basis anyway. So I don't know what's going to happen, but Biden's proposing that the stepped-up basis goes away.
So you'd have to do the gift tax return, but it's sort of like a bookkeeping form, not going to cost you anything. Next one is I received 403B required minimum distributions early in 2020 from a carrier who did not accept redeposits. Those funds were deposited to a Roth. Are those deposits taxable?
I don't understand that. So they got a 403B distribution, and then they redeposited it into a Roth? Is that what it reads? Do you think that's what it says?
From a carrier who did not accept redeposits. So they must have wanted to redeposit it because they didn't have to do
I know,
the
but they
R&Ds.
sounds like they redeposited it into a Roth.
Traditionally put it into a Roth.
Well,
so
if
then
the
it would be taxable.
403B
Those are
distribution
taxable.
was out of traditional, putting it in a Roth, it's just going to be taxable.
So those are, to answer your
So,
question, those
but
are taxable.
what I would tell you is you need to call us so we can find out, because you certainly don't want to go on what I'm saying when I don't have all the facts. But if you took it out of a traditional and you weren't able to put it back within time to make it not taxable, and you put it into a Roth, it's going to be taxable.
And then next text, to make sure we get it in, I do woodworking for a living, and I'm having to wait up to 6 weeks to get my standard order of lumber that I used to get in 1 week, Chris. So that parlays to what you're saying, Chris.
Yep, that's what I.
God, that's crazy. I have to wait up to 6 weeks to get my standard order of lumber that I used to get in 1 week.
Yep.
That's sad.
Well, that's the whole COVID thing. I mean, people aren't working.
Yeah,
Right.
well, what's amazing is, like, you mentioned Christmas trees, but you go into Walmart, Home Depot, Lowe's, all these other stores, and you go to buy Christmas lights or Christmas decorations. They're all sold out already because people are home. They're bored, so they're going and getting stuff for their yards, and that's what's probably happening with the building materials. They're doing it themselves,
Yeah.
so...
Time.
And people have nothing to do but watch HGTV, right?
That's
okay.
true.
Other things you should do. The capital gains could change. I mean, we just talked about it with our gentleman from Wilson. Under the Biden proposal, he wants to eliminate the stepped-up basis.
And I got to tell that guy from Wilson, Chris and I just refinanced with cross-state funding, and the rate that we're getting, what is it? Was it
Below
2
3.
Below 3.
I mean,
and so,
you figure if you're at a 4% mortgage, you go to 2
Right.
on 100,000. That's about $200 a month you should save. I mean, that's a lot of money.
Yep.
So anyway, capital gains rates are supposed to go to ordinary income, because right now there's a big favorable treatment to capital gains. Under Biden plans, the stepped-up basis is supposed to go away, and it's going to be ordinary income. Gifts of cash, you can give up to $15,000 per person per year without having to file a gift tax return. That's why the person giving the $100,000 has to do a gift tax return. And the estate exclusion is also projected to go down.
right.
Keep a close eye on taxes, and I will tell you, I don't know. We don't know what's going to happen the next 18 days, but they are talking about taxes. Every time they do something with taxes, they stick something in that has to do with you. So we'll keep you abreast of that. Pay up deductible items, medical, taxes, interest, charities, miscellaneous itemized deductions are still deductible on the state of New York. So even though you can't deduct them on the federal, you can on New York State, especially like over-the-road truckers and outside salespeople. This is very important. Make tax-free withdrawals from pension or IRA. If your income's lower, we're saying don't take money out of your RMD, but you might want to. So,
Can you... I know you don't have to take your RMD out this
but
year.
You might want to.
Right, but can you still do your QCDs?
Up to $100,000.
Right. I mean, because there was no minimum distribution,
right.
The idea was to help not use your minimum distribution on your return.
So your QCD, explain that to people, what that is.
A qualified charity distribution.
I was thinking about that about a half hour ago.
So
up to $100,000.
Up to $100,000 you can send directly from your IRA.
If you're 70 and a half.
If you're 70 and a half, directly to your charity. Therefore,
it's tax-free.
It will be tax-free. It won't show up on your tax return. You don't get the charitable write-off, but you don't have to claim it on your tax return, which could also help keep your Social Security down. Or as one of the first callers, your IRMA down.
Right. And that's really important. And by the way, if your IRMA is getting taxed, like Chris said and Tiffany said it before, and you had a life event, like you sold stock or you took a bunch of money out of your IRA or whatever, they have been very successful in getting that IRMA reduced. So take control of your finances. If you owe the IRS money and you just said, with all the stuff that's gone on, I just can't deal with it, give Tiffany a call. She does offers and compromise. They will accept reduced payments, substantially reduced payments, pennies on the dollar. They want to get you back in the system.
Now's
and
a great
don't
time to
forget,
do it.
when you see these ads on TV that says that we can get your debts forgiven, debt forgiveness is taxable. So you got to put that all into the equation. I will tell you, if you have questions, call EG Tax 632-7886. Go to our website. You can ask me questions, ask the tax lady. Until next week, and if anything major happens, we'll be on the horn with everybody and letting them know. I'm Esther Gulias, Tiffany Fabian, Christopher Fabian. Have a good week. God bless you. Thanks for listening. Bye-bye.